How faster settlement changes capital exposure. Compressed settlement windows change the questions institutions must answer before capital moves. When settlement becomes near instant, funding and collateral that once rotated over days must now be available at execution. This introduces real-time settlement risk and reshapes digital asset liquidity management. What real-time settlement risk means. Real-time settlement risk arises when trades finalize faster than funding, collateral, or counterparty readiness can support them. In traditional markets, multi-day cycles allow time to move capital and reconcile discrepancies. In programmable markets, that margin disappears. Immediate implications include compressed funding cycles. Liquidity must be pre-positioned. Collateral strain. Assets must be allocated in advance, not assumed available. Intraday exposure. Margin needs can increase within minutes. Exposure becomes a function of operational readiness, not conviction. Liquidity must be positioned, not assumed. Digital asset liquidity management now requires precise capital placement. Liquidity held in the wrong venue, wallet, or chain cannot support real-time settlement. Capital that is theoretically available but operationally inaccessible creates risk. Managers must design liquidity buffers that account for settlement speed, funding pathways, and venue fragmentation. Timing replaces flexibility. Operational risks amplified by speed. Faster settlement surfaces vulnerabilities that slower cycles masked. Routing errors become irreversible. Platform outages disrupt immediate funding. Counterparty mismatches create settlement gaps. Automated margin calls cascade quickly across linked positions. Operational design must validate preconditions before execution. Prevention replaces correction. Governance and technical controls. Mitigating real-time settlement risk requires coordinated responses. Key measures include pre-trade validation of addresses, counterparties, and collateral availability. Tiered collateral pools separating intraday settlement assets from strategic holdings. Liquidity orchestration layers that route funding dynamically. Staged authorization for high-value transfers. Rehearsed contingency protocols for settlement failure. Each measure reduces exposure at the point of execution. Compliance in compressed cycles. Faster settlement increases compliance obligations. Governance rules must be embedded directly into execution systems. Best practices include policy as code, enforcing limits automatically. Real-time audit trails documenting authorization and validation. Segregation of duties across execution and custody roles. Automation enforces discipline at machine speed. Why this matters for capital. Compressed settlement increases the likelihood that operational gaps become realized losses. Liquidity mismatches and funding shortfalls directly threaten capital during stress. Institutions that redesign liquidity architecture and governance frameworks preserve optionality when markets tighten. Capital protection now depends on preparation, not reaction. Kenson Investments provides structured frameworks to mitigate settlement risk and protect capital in fast-moving markets. If your organization is adapting to near-instant settlement, clarity begins with liquidity design. Visit kensoninvestments.com and connect with our team.